Hello and welcome back. John Flynn here from Flynn Real Estate, serving Southern Ontario, based out of the Niagara region. Thank you all once again for tuning in. I just got back from a road trip. I was away for a week, literally just got back last night late. The picture in my background is from somewhere I went. If you know where it is, drop me a comment in the comments below and let me know if you do know where that is or where you think it is. This week, I got a bunch of things to talk about. I'm going to give you an update on bank sales, some statistics that I missed last week from a bunch of places that weren't ready because it was very early on in the month. So Quebec, New Brunswick, Vancouver, and a few other places. I want to talk about the Bank of Canada Vulnerabilities Report and the hidden inventory. So let's get right into this. I'm going to start with an update on the bank sales. So I have two areas, the Toronto Real Estate Board and the area surrounding those, the ITSO. Starting with the Toronto Real Estate Board, you can see I only started tracking these in June because that's when I became a member, just before that. So you can see they have increased, nothing substantial yet. They're at about 126 for any active and conditional listings right now, but they are trending up. And onto ITSO, I've been tracking these since the beginning of the year. These are the 20 boards surrounding the GTA, for those of you who don't know. So we've pretty much doubled from the beginning of the year. We were around 20 early on at the end of January, and now we're well over 40 listings. Not a substantial amount, but still they are increasing consistently in both areas I look at. Next, I want to move on to the Bank of Canada's recently updated report. They update this from time to time, and it is the indicators of financial vulnerabilities. Now, there's just a few charts I want to point out in this, but I do want to just read the description at the top. Get quarterly data for the indicators we use to track the evolution of two vulnerabilities in the Canadian economy: the elevated level of household indebtedness and high house prices. So I don't know if they're saying this is the only two major vulnerabilities, but this is, again, not a housing report. This is a financial vulnerabilities report. So anyway, I found some pretty interesting graphs in here and charts, so I just want to share those with you. If you want to read the full report, you can see the link in my description, and you can read the whole thing there. The first chart is the number of mortgages originated, and this is for insured mortgages. And this chart goes back about 9 to 10 years to 2014, early 2014. And you can see it did spike in 2021, and we are well below the 10-year average right now. Now, the second chart here, this shows the share of all new mortgages with a mortgage debt service ratio greater than 25%. Looking at the long-term average there, you could probably say it's around 14% of people's income goes to servicing that debt or that mortgage debt. And you can look at now in 2022 and 2023, it's like almost 30%, well over double what it used to be for the long-term average. So there's a lot of people's income that are going to their mortgages now, as expected with the affordability. But again, seeing this in chart form really kind of sheds the light on how things are prevailing right now. And the last chart I'm going to share in this, probably the most significant in my opinion, is the share of mortgaged home purchases percentage-wise by the type of home buyer. And the green at the top there is investors. And they classify an investor as somebody that already has a mortgage on another property and they have purchased another one. You can see that over the last 10 years, we've gone from about 20% of the mortgages, which was still high. In 2014, there was a lot of investment in Canada in the residential sector. And we're now closer to 30%. And the last little bit there is Q2, actually it's Q1 and Q2 of 2023. So the investment hasn't slowed down for a percentage of new mortgages anyway. And you can see who's getting squeezed out there. The repeat home buyers are getting squeezed in the middle. The first-time home buyers, their percentage of mortgages on new homes or on resale homes or whatever the case may be has declined. That used to be at 50%. It's heading down towards 45, and if not 40% eventually. So less end users buying the homes and more investors. Like I always say, I've always revert to the same topic. There's too much investment, and that's why people are getting squeezed. They've driven up prices and they're taking more of the market share. Moving on to my next subject, which again kind of combines these two things, affordability and investments and rentals and whatnot, is the number or the hidden inventory that nobody talks about. I've talked about it before, but this is, basement apartments, in-law apartments, whatever you want to call them. This is in my area, in the ITSO area. The first chart I just want to show here is the ITSO sales per year. This is all residential sales by year, going back to the year 2000. And you can see they've kind of remained consistent. We have had a bigger spike in 2021, over 100,000 sales, but they always fall in that 74 or 73,000 to that 77,000 sales per year, which is kind of odd considering our population has increased a lot since then. And one more thing I want to point out on this chart is the 2022 level of sales is the same as the 2008 sales. So it's a big drop in 2022. Just to put it into perspective, people talk about new listings being at all-time lows or 20-year lows or whatever the case may be. But as you can see here, the sales are at a 15-year low or something. So very similar, low listings and low sales. Now moving on to take a look at that hidden inventory in the form of in-law apartments, because in-law apartments aren't tracked through housing statistics for increased units per year and whatnot. So I kind of just wanted to look into it to say how many units or how many in-laws would have been created and how much inventory has that added to the Canadian housing supply without people noticing. Again, tracking that same data back to the year 2000, and you can see there was well under 1,000 in-laws that came up for sale on the system. And in 2021, that number was almost 5,000. So, 2021 was a big year in sales, but again, it went up 5 times from year 2000 to the year 2021. And if you compare the other years recently too, it's still over 3.5 times more in-law apartments that are included in listings. Now, when listing a home with an in-law apartment, we have 2 options. We can check it has an in-law setup, or we can say it has an in-law capability. So I wanted to add in that in-law capability also into this data. The orange is the in-laws, and the light blue or turquoise or green or whatever the color it is the capabilities. Again, huge spikes, even bigger than the in-law apartments, but huge spikes because the demand, again, for in-law setups is big. So the in-law capabilities would be flagged more often on the systems now. So now I want to translate that information into the percentage of sales and how has that increased, decreased over the years. So this chart here is the percentage of all sales in the 20 boards surrounding GTA that had in-law setups in them or flagged on that on MLS systems. Back in 2000 and 2001, it was around 1.5%, with that spiking to almost 5%, about 4.75% in 2021, still carrying well over 4%. So far in 2023, we're about 3.6% or so. And now let's add in the in-law capability data, and you can see, of course, the spikes are huge. It went from under 2%, probably 1.75 or so, to almost 12.5% in 2022. In 2021, 11% or so. So there has been like a huge increase in the potential in-law setups. And of course, in-laws themselves have increased in the home sales. So of course, there has been a huge increase in this hidden inventory by way of in-laws and in-law capabilities. Now, to quantify it, there's around 8 million to 9 million, depending on who you talk to and where the data comes from, detached and semi-detached homes in Canada currently, not just new homes, just all homes combined. So if we had just say on the low end, 4% of these were in-law setups that were unaccounted for, you'd have approximately 320 to 350,000 units that are unaccounted for. If you want to go on the higher end and say, look, it's 10% or 5 to 10% in some areas, you could be upwards of 800,000 additional units that are unaccounted for. Now, we have lost a lot of inventory to Airbnb and vacation rentals over the years, but that inventory is still there. It's just tied up elsewhere, and there's a lot of rules being created all over the place that will bring some of that supply back online. And as the economy slows, people will stop paying for these Airbnbs or going on vacations in general. So you will see a lot of that inventory come back online as people sell and convert back to long-term rentals. So now moving on to the data and the stats from the areas I didn't include last week because it was too early in the month. But starting off with the sales to new listings ratio, you can see here in the gray areas from 44 to 58%, the balanced market, and that includes Chilliwack and District, Fraser Valley, Victoria, Ottawa, Windsor, Essex, Montreal, Chatham, Kent, and Greater Vancouver, with the last few there being closer into the seller's market, but technically they still are in a balanced market. Province of Quebec is just in a seller's market as a whole, And in the overheated sellers market, meaning the sales are far outpacing the new listings, you have most of the Atlantic areas and provinces. So Newfoundland and Labrador, Nova Scotia, St. John, New Brunswick, Greater Moncton, New Brunswick, and Saskatchewan's in there too. Moving on to the month-over-month price changes, losses or gains. Ottawa is down 6.2% from July to August. Nova Scotia down 3.9%. Greater Moncton down 3.9%. Fraser Valley down 3.5%. The rest there in the red, Victoria, St. John, Quebec, Chilliwack District, Saskatchewan, less than 1%, with Montreal even. Greater Vancouver up 0.8% month over month. I don't know what's going on out there, Vancouver, the most expensive real estate in Canada and possibly the world, and they're still getting monthly increases given the interest rates. I guess people don't need mortgages in Vancouver as much. Windsor and Essex up 1.3% month over month. Newfoundland and Labrador up 2.3% month over month. And Chatham, Kent up 12.8% month over month. Not a huge data set there, so it will swing wildly. I had someone ask me in the comments to include that. I think this is why. I think they knew it was up significantly. But again, it's very volatile given the small data set, I'm guessing. And looking at the percent change from the peak or the percent losses for most areas, Fraser Valley leads the pack there, down 24% from the peak. Chilliwack and District next at 22%. Windsor, Essex down 22.1% from the peak. Ottawa down 15.5%. And you go down the list, many around the 10%, the Nova Scotia, St. John, Greater Moncton. Victoria down only 6.9% from the peak. Saskatchewan down 4.1%. Quebec down 3.6%. Greater Vancouver down 3.6%. Montreal only down 1.6%. Very stable market there, it seems. And Newfoundland and Labrador up 0.6%. Congratulations, Newfoundland and Labrador. I think you're the only place that went up or is up from the peak, setting a new record. So you're setting records in Newfoundland and Labrador right now. And looking at that in dollar value, Fraser Valley down 308,000, Chilliwack and District down 203,000, Windsor, Essex down 159,000, Ottawa down 117,000, Victoria down 70,000, Chatham, Kent down 62,000, Nova Scotia and Greater Vancouver down $47,000 each, 35,000 and around 30,000 for St. John and Greater Moncton, New Brunswick. And Quebec, Saskatchewan, and Montreal down 10 to 20,000, with again Newfoundland and Labrador 2,000 above their all-time high, setting new records. Okay, so that is it for this week. Drop me a comment below like always, and until next week, I'll see you then.